Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
The first jobs report of 2025. Will it build the case for a substantial pause? Barely a week to the inauguration. Expect 100 executive orders on day one from President-elect Donald Trump. And TikTok's big day. The U.S. Supreme Court will hear the social media platform's challenge to the scheduled ban. Good morning, Manus. Happy Friday.
Danny, good morning. Happy Jobs Day. We're looking at a bond market that's 469 in the Treasuries. It ticks up ever so slightly. We're up for 6 days in a row. We put on 13 basis points in U.S. 10-year yields. The estimates for this non-farms are wide and varied. As a house, we're going for over 260. Veronica Clark will join us. She's going for 120. And the whisper is somewhere in the high 60s, 70s. But the question is, this slope is now the steepest since 2022. Gilts, by the way, no reprieve for the gilt market. 5 days in a row, it's up. Two different stories. One is about term premium here in the United States of America, and in the UK, it is now about solvency and fiscal angst. Roll it over to the stock market. It is Jobs Day, as I say. The consensus estimate is for 165,000. We're down a third of 1%. We've got the Bank of America flow show out this morning. Money markets had their biggest inflows since April 2020. No shock in that. And these high bond yields and a high dollar is going to force the Fed to turn unambiguously hawkish, and that will hit stocks.
Well, one stock that we're always keeping our eye on, Manus, it is Nvidia this morning. It is falling in the pre-market session. It did come out with a new criticism to the Biden administration on its new chip export restrictions. Those shares down 1 1/4%.
And AMD also falling. Nvidia's response in Goldman Sachs is cutting up its recommendation on the stock to neutral from a buy.
And TSMC rising in the pre-market. Sales beat estimates. It boosted the AI outlook for 2025. That reinforced investor hopes for their earnings to come.
And in just a few moments, we'll catch up with Simon Dangoor of Goldman Sachs Asset Management. A little bit later in the hour, Veronica Clark can give us her estimate, 120,000 in the flesh around the desk on the jobs report. The whisper number, I was way behind there. I was trying to sort of make it up as I was going along. Of course, consensus is 165. The whisper number is 180.
Make up things, Manus. We don't make up things.
Well, you know what I mean. It started at 167 when I walked in at 2:30. It's 185 now.
But you made this point. I mean, it's a really wide range, 100,000 to 268,000. It underscores the uncertainty of the moment, which you could also say the bond market underscores too. This rise higher in the long end of yields. It's almost as if the bond market and economists are saying, we have no idea what's going to happen. The equity market shows that too. We're retreating to the corners of the safe things like money market funds. You mentioned the flow show this morning, and big tech.
And it's interesting, in this dislocation, you've actually seen a flow into the Treasury market. And this is where, are you fearful or are you brave? Well, I'll tell you what, you want to be pretty brave in the UK market at the moment. I want to show you what's happening in the gilt market. We mentioned it at the start of the show. This is the 5 days chart for the UK. You're looking at an extension higher by 26 basis points. But I want to show you the CDS. Now, this is interesting, Danny, because if you look at the mini budget, this is the cost of insuring against default. Nobody's saying the UK is going to default at the moment. In September time, there's a small jump, but the CDS has really ratcheted higher. That goes to the narrative that we are now talking about solvency and fiscal angst in the UK, as opposed to term premium in the United States of America. Simon Dangoor is the head of fixed income macro strategy over at Goldman Sachs. He joins us now for Goldman Sachs Asset Management. Simon, we understand it's a term premium let's say, issue here in the United States of America. If I look at what's happening in the UK, let's start there. We're now talking about debt sustainability in the UK. How tenuous a moment is it?
Thanks so much for having me on this morning. It's great to speak with you again. Look, it is an interesting moment in the UK. UK is always in something of a tight spot where the cost of global funds, particularly in the US, goes higher, just reflecting the current account deficit structure. And I think in many respects, the government has set itself up in quite a tight spot itself with how they've defined fiscal rules. I mean, I think to think about it as a major challenge to solvency as opposed to some of the trade-offs around how the government has laid out its fiscal strategy is maybe sort of overdoing things. I mean, when we think about the UK, one of the things that we think is somewhat overstated is that the risk that the UK is in some very poor position with respect to stagflation. And that when we look at, for instance, the labour market going into the recent episode, that looked to be weakening and softening to a certain extent. And so we think that some of the strength in wages that we've seen in recent months is probably going to come off. Similarly, when we look at the inflation picture, some of the data has been disappointing, but there's a number of the more cyclically sensitive parts of the basket that are showing progress. And so if you wind the clock forward a few months, we could certainly be faced with a situation where the growth inflation trade-off doesn't look quite as bad in the UK. That can create some policy space for the Bank of England. There's really not a lot priced for the Bank of England now, only 50 basis points for the rest of this year. And that can start to make us appear that we're getting to a better equilibrium. So we actually see some opportunities being created, but more focused on the very front end of how the interest rate curve is priced in the UK. Further out the curve is very much going to be a function of what's happening with the global price of yields.
To that point, Simon, there has been a ramp higher globally. It is not just the UK, even if it is the epicenter of it. Perhaps was led by the U.S. with 10-year yields at their highest since April of last year. In France, it's an October 2023 high. In Germany, it's the highest since July. Has something shifted in these markets, and is it a reason for concern?
I think we're all sitting as investors, and you mentioned it in your introduction, and watching to see what we're going to get out of the next administration in the US, and particularly on the fiscal side of things. Dependent on that, I think fiscal is going to be something which is a focus of the market. That said, our base case is that probably the market is somewhat putting in some risk premium around this, and that the reality of what we're going to get out of the new administration is probably not the most extreme manifestation of some of the proposals that have been out there, and certainly that got talked about in the course of the election campaign. So perhaps once we start to get clarity around those prospects, we can see some moderation play out. And I think if you start to stabilize that could be something which is important for bond markets globally. I mean, I think the tactical call on duration is kind of tricky here. The Fed's moved to this stance where they're much more focused on the upside risk management around some of the potential effects of the policies of the incoming administration. Those things aren't going to rectify themselves or clear themselves up in the context of the next couple of months. And the US growth data looks pretty healthy at the moment. So tactically, there might be opportunities to get duration in at better levels. But when you zoom out and you look at where yields have gotten to, we now have five-year real yields comfortably above 2.5% in the US. So some strategic value is opening up to quite a lot of different scenarios.
It's good to hear you sound less fearful and perhaps more opportunistic than some of the other calls that we've had. Simon, today it is jobs day in the USA. The estimate is 165. It's wide and varied. I like what you say, which is it is the US data which will earn the cut. And with that in mind, we're so tethered to the NFP headline number. Is that the right data point that will earn the cut? And what is it that will deliver that?
Well, we think the most important thing to focus on in today's report is the unemployment rate. And in spite of the fact that the Fed moved to this more circumspect view about the distribution of risks at their meeting last month, when we look at the underlying inflation picture in the US, we still think it's consistent with the level where the Fed would be pretty quick to move back to cuts if you start to see a re-weakening of the labor market, and particularly seen through the lens of the unemployment rate. Each monthly payrolls has lots of issues associated with various different distortions, with seasonals, with how much it gets revised these days. And we think the unemployment rate is probably a better indicator of really what's going on in terms of the tightness of the labor market. There's a decent chance we print a 4.3 today. I think that will be important. Again, whilst we look at the US economy and things look reasonably healthy, if we do start to see unemployment move up again, 4.3, 4.4 in the course of the next couple of months, that could very easily bring the Fed back to the table and earn those cuts that you talked about. Remember, in the SEP that we got last month, the Fed really didn't have unemployment going more than 4.3 at really any stage.
Our survey estimate currently has 4.2%, the estimate for the unemployment rate. Simon, really great to get your thoughts this morning ahead of Jobs Day and after some of the UK turmoil. Simon Dangoor of Goldman Sachs Asset Management. Let's get you some other stories now that are trending on the terminal this morning. Wall Street executives are locking in plans toward traders and deal makers' big bonuses, with hikes of 10% or more. That, according to people familiar. The raises follow 2 years of industry-wide restraint, while investment banks struggled to maintain the flurry of trading and deal making that they handled at the height of the pandemic.
Apollo is considering taking a substantial stake in a bid by Seven & I's founding Ito family to take the store operator private. It's discussing a commitment of as much as $9.5 billion of an equity stake in the plan that would join the family as a key investor. That's according to people familiar with the matter.
DOJ officials are likely to discuss raising their inflation outlook at a policy meeting later this month. According to people familiar, it's mainly due to a recent surge in the cost of rice and the weakening of the yen since the last outlook report in October. The central bank currently sees underlying inflation rising 2% this fiscal year. Coming up, the clock ticking for TikTok. That's a pun for you. It's only 9 days before a U.S. ban is going to come into effect on the social media platform. We're going to have more on the Supreme Court and their decision coming up next. Welcome back to your Bloomberg Brief. Danny Berger and Manish Cranny here in New York. President-elect Trump has two words on his mind: executive and order. Bloomberg sources say that the incoming president is planning to sign a range of executive orders as soon as he returns to the White House. Some reports tally the number to reach 100. For more detail, let's bring in Bloomberg's Rosalind Matheson. Roz, 100 executive orders on day one. What could this look like?
Well, 100 could be a lot. As we know, the big question was how hard out of the gate was Donald Trump going to come in his second term on day one? And it seems like he is going to come out with a lot from the get-go. And that's all about showing quick results from the things he said he wanted to do as soon as he was in office. And so it could be a range of things across some of his key topics: migration, tightening things at the border, resuming activity with his border wall. Then we've got on the regulation front, perhaps a hiring freeze for the government, although that could lead him into trouble with unions very quickly. On the energy side, resuming new drilling on federal land. And of course, does he pardon even more of the Jan 6 rioters? And for overseas, what does he do out of the gate potentially when it comes to trade and tariffs? He's talked a lot about putting tariffs on a variety of countries. Does he try and enact some of that agenda very early on, or does he focus more on domestic US issues? So it's going to be a lot to absorb on day one. The interesting thing will be how much of that can then bear up under reality, how much of it comes under immediate challenge, legal challenge and whatnot, particularly on the migration front. We can expect that. So it's going to be a very, very busy period from the get-go.
I think if history is anything to go by, it's about that grand political win, that grand bargain that he's made with the American public, and it's about being seen to deliver on that on day one. Look, we also heard from President-elect telling a reporter at Mar-a-Lago yesterday that a meeting with President Vladimir Putin has been arranged. Now, the Russians say they don't have any specifics on this. We know that Trump has spoken about the issue about NATO in Ukraine, etc. This is going to be front and center geopolitically. What do we know exactly about this?
Well, we know very little, as you say. He simply just said that something was being, quote, set up. We don't know if there's been any actual outreach or it's just an intention at this point. We don't know if there's any back-channeling that's been going on or whether there's been something through an intermediary. And if so, who would that be? Because it can't really be Finland anymore. Obviously, now they're in NATO. And so how advanced is this, or is it just an intention at this point? Because, of course, a phone call with Vladimir Putin is one thing, but an in-person meeting is a very big deal, given all that's happening in Ukraine, given US sanctions that are heavily put on Russia. How do you have this meeting in person? Where do you have it? What are the parameters around this meeting? But it's very, very clear that it is Donald Trump's intention to try and bring the war in Ukraine to some sort of resolution early on in his term. What that looks like, we don't know. But a meeting with Vladimir Putin would certainly be a big moment early on in his administration.
Yeah, as you say, Roz, where would the logistics of this be, and all the issues around that? Roz, thank you very much. Roz Matheson there with the very latest political news flow. Now, as Washington prepares for the transition in 10 days, NVIDIA slams the outgoing Biden White House for trying to undercut the incoming Trump administration. The tech giant criticized the new chip export restrictions that were reported on Bloomberg on Wednesday. In a statement, NVIDIA's vice president for government affairs said this: The extreme country cap policy will affect mainstream computers in countries around the world, doing nothing to promote national security, but rather pushing the world to alternative technologies. Glad to say Tom McKenzie is with us on this story. Tom, look, this is a very, very clear pushback at this last piece of policy from the Biden administration. What good will that do at this stage? Is there any way to backtrack on this? And what is the real implication for NVIDIA from this potential ban?
Well, Manus, I think you nod to something which comes out of this statement, a scathing statement, as you read out, which is that this is as much for the current audience, the current Biden administration, as arguably it is for the incoming Trump administration as well. This seems to be directed at Trump and their team when they take over from January the 20th. And it underscores the concern that NVIDIA has about these measures. NVIDIA that has pushed, for example, for sovereign AI, which would involve countries, nation states, buying and building out their own AI accelerator clusters. That proposition gets undermined if you're in a situation where you are one of the majority countries falling into tier 2, where you have to essentially meet a cap in terms of the number of these NVIDIA chips and others, AMD, that you can actually get hold of. And again, most countries fall in to that category. There are 3 categories. First, allies of the US, like the UK, Canada and Japan. And the third, Russia and China, who are completely blocked. And it's the second, the global picture, most other countries. That seems to be where the concern is for NVIDIA. And again, I think the statement is aimed not just at the Biden administration, but the incoming Trump administration as well, saying, look, this is going to undermine the legacy of the Biden administration, but equally saying that the Biden administration should not preempt Trump. So it seems to be a nod to them, maybe a call for help, rethink these restrictions. We'll see what happens. Rubio, we know, is supportive, the incoming potentially Secretary of State, of further restrictive measures on China.
Well, it does underscore, Tom, this moment where tech companies feel that they can win if they specifically appeal to Trump to save them. TikTok is another great example of this. TikTok getting the backing of President Trump to allow them to continue on and not have to sell their U.S. business. But we have this deadline, TikTok appearing before the Supreme Court before the ban takes place on January 19th. That happens today. What are the range of outcomes we could have after this, Tom?
Well, we know that this is a bipartisan law, of course, so backed by both Republicans and Democrats and signed off by President Biden. No one knows exactly how the Supreme Court will rule, and that goes to them later today, of course. The various outcomes are it is banned, and it gets banned before, of course, Trump gets into power. He's inaugurated just one day before. The other outcome is potentially that they push, the Supreme Court decides to push this back, gives them some breathing room to work out a deal. The other option further down the line is that there is some form of acquisition. TikTok US, they have no intention to sell the US business. But we know that Trump has made it clear that he wants to be an environment where TikTok still does exist, but he addresses those national security concerns. And he says, and he has made it clear, he wants to work out a deal. Analysts at Morgan Stanley say that could come down to, for example, companies like Amazon could be a potential buyer. It would align with their social shopping push. Microsoft, Oracle, those are other names that have been pitched by some analysts who had previously expressed interest when Trump himself in his first term had tried to ban TikTok. The outcomes are varied, but this is a crucial point for the advertising revenues of this industry. $10 billion is how much TikTok brings in, approximately. That could go to Instagram, Meta. It could also, of course, go to other social media players within that space. They could be the beneficiaries. Oracle, though, on the downside, TikTok's one of the big customers for data centers. So it's going to have a varied impact across the ecosystem of tech in the US.
Where will Manus Cranny post his TikToks? That's the big question if this happens, Tom.
More importantly.
Thank you so much. Bloomberg's Tom McKenzie there with the latest on TikTok and other tech stories we are following. Okay, coming up on the show. Firefighters have regained some control over the Los Angeles fires. The government responding to the tragedy. We are going to bring you the details next on your brief.
Front pages, as we go to the close of the week, look like this from around the world. This is what we got for you. Wall Street Journal kicks off reporting that UBS is close to a settlement over tax evasion by Credit Suisse. UBS is said to pay hundreds of millions of dollars to settle violations as soon as this week. Credit Suisse pleaded guilty in 2014 to helping Americans evade taxes, but still harbored hidden accounts.
Next up, the New York Times leading with the nation saying farewell to former President Jimmy Carter. 5 living presidents and other leaders gathered at the Washington National Cathedral yesterday to pay tribute. The son of former President Gerald Ford delivered the eulogy his father had written for Carter before his own death in 2006. He called him an old friend and said he looked forward to their reunion.
And on Bloomberg, the firefighters are regaining some control over the fires in Los Angeles. It has forced 180,000 residents to flee, causing economic losses estimated between 135 to 150 billion. That's AccuWeather. There are other numbers out there. President Biden spoke on how the government would help the wildfire victims.
So today I'm announcing that the federal government will cover 100% of the cost for 180 days. It's going to pay for things like debris and hazard material removal, temporary shelters, first responders' salaries, and all necessary measures to protect life and property.
Of course, our thoughts go out to all the devastation happening there. We will keep you up to date with any developments as they come. Coming up in the show, we're going to be pushing ahead to the payrolls report. We're going to catch up with Citi's Veronica Clark with a wide range of estimates from 100,000 to 268,000 for your jobs report. That's coming up next. From our global headquarters in New York City, welcome to Bloomberg Brief. Danny Berger, Manus Cranny here. Let's set your agenda.
It is the first jobs report of 2025. Will it build the case for a substantial pause? Barely a week to the inauguration. Expect 100 executive orders on day one from President-elect Donald Trump. And TikTok's big day. The U.S. Supreme Court will hear the social media platform's challenge to this scheduled ban. Danny, good morning.
Good morning. It is Jobs Day in America. 3 hours to go till your non-farm payrolls. U.S. equities back online after they were closed yesterday for National Day of Mourning for the late President Jimmy Carter. We start the day with declines led lower by Russell 2000 futures down by 0.5%. Perhaps it is because of what's happening in the bond market. Let's get a picture of your global bond market this morning. U.S. Treasuries steadying this morning at 4.68%. Your 10-year yield in the U.K., that continues to go higher, 2.5 basis points, a 2008 high. The move also reflected, not as severe, but in the rest of Europe too. The German 10-year yield up by a basis point. That is the highest since July. Manus, it is a moment of reckoning and a moment of a closer examination of the fiscal positions, but also a moment of uncertainty. And I think that's what some of this is reflecting, that we just don't know what's going to happen, let alone what happens after January 20th. But even in this moment, there's a lot and a big range of estimates for today's job report.
There's a huge range of estimates. And just going to the bond market, we just had Goldman Sachs Asset Management. They sound braver rather than more fearful at these levels, both in gilts and in terms of the bond market. And that's very, very interesting because these are two very different stories, Danny. This is about term premium dislocation here in the United States, jolting our bond market relative to fiscal headroom in the UK. And that is about liquidity and sustainability. Two very, very different markets. But the jobs number today, that could perhaps put a cap on some of these romp home in the bond market, or indeed propel it higher.
Well, Michael Hartnett of Bank of America was writing about this today. This idea that you are going to get a steadying in the global picture. And once that happens, maybe by that point, yields already at 5%. And there's going to be a huge buying opportunity and a big reversal in some of these more bearish markets. Exactly,
but the 2s10ers are steepening at the moment. It is jobs day, as we've been saying to you. There's lots of numbers out there. We've got the consensus number, and we have the whisper number. The whisper number at the moment is 180,000. Let's bring in Mike McKee. It's moving around. I mean, it was a lot lower when I came in at 2:30. Yes, 2:30 in the morning. Mike, good morning to you. Set the stage for us, because we're anchored around NFP, but maybe we should be more focused on the unemployment rate.
Well, the Fed is more focused on the unemployment rate. And as you noted, there's a very wide range of estimates for job creation overall. You were talking about market reaction. if we don't get a major surprise today, I think market reaction, the question is going to be, what would you like it to be? If your thesis is one thing, you'll see the market go that way based on these numbers, because this is sort of a plain vanilla report if it happens the way economists think. The consensus thinks 165,000 is still reasonably strong job creation. It would be stronger than the Fed's view of what's needed to keep the economy and unemployment rate steady. The unemployment rate not expected to change, basically stay at 4.2%, which remains kind of low. The Fed wouldn't move on any of those numbers, and that's what's already in the market. So, do you have a significant trade coming out of this if we get an as-expected report? You wouldn't think so, but then, as you say, this is a world of uncertainty right now.
Yeah, anything can change with just one number coming out again in 3 hours' time. Given the Fed speak that we've heard, Mike, more recently, a lot of the concentration seems to be one of caution, but based on inflation, especially with jobs data coming in today. Is this a Fed that's started to shift yet again and focus more on inflation figures than that of the labor market?
That's basically what they're telling us. They're looking at the labor market and they're saying the labor market, unless there's a surprise, is relatively strong right now. The unemployment rate is still at a reasonably low number. I mean, it's still below what a lot of people think the inflationary level of unemployment would be. And so at this point, the Fed is content to sit back. And I think the way they're framing it is, we need to see a reason that we would want to go back to cuts.
Yeah.
As opposed to we need to see a reason to pause, which was the prior story. So unless we get some reason today, everybody's focus is going to turn to CPI next week and what we get in the inflation numbers. And you saw a chart we just had up there a second ago. The market has priced in a little more chance of 2 rate cuts this year, but they're still under 2. They're still looking at 1 rate cut as sort of the base case, which is even lower than what the Fed thinks.
Yeah, we've certainly seen some of that backing off in recent days. Mike, thank you so much. Looking forward to you breaking down the numbers, 8:30 a.m. Eastern Time. Bloomberg's Mike McKee there. Citi's Veronica Clark also weighing in on labor data, writing, quote, "We expect the unemployment rate rising above 4.5% in the next few months to cause a sharp repricing of Fed rate cuts this year, with 125 basis points of cuts still our base case." Pleased to say that Veronica joins us now. Veronica, so great to see you.
Thank you for having me.
Thanks
Happy
for joining us.
2025.
Happy 2025. Happy Jobs Day to you.
Happy Jobs Day.
So you see some weakness really coming in for this labor market. You've been consistent on that. How far will we get there in today's report?
Yeah, we could get close. So I think we are maybe the high estimate for where we see the unemployment rate going today. We have got 4.4%. I think part of the issue is, and I am much more focused on that unemployment rate number today, part of the issue is it has increased the last couple months. It's been within this recent range, but the last couple months we've actually seen that unemployment rate increase, but with people dropping out of the labor force. If you do get those people returning and looking for work, they easily could be counted as unemployed again. That's a big upside risk for this number today.
Where are the implications then on wages? Because we saw the quits rate at quite a low level relative to the past couple of years. And I've got a couple of people on the IB saying, the power of wage negotiation is dissipating. Now, this is the other portion which plays into the inflation narrative, Danny. So where are you in terms of wages?
Yeah, no, I think that's true. I mean, a loosening labor market, less demand for workers, less people moving jobs, all of that should mean that wages are slowing. And I think we do see that. Average hourly earnings, which we'll get today, is maybe the first measure of wages that people look at, but it's a very crude measure of wage growth. It really is just the average wage. So if the composition of types of jobs, employment is changing, if it's more higher paid jobs, then that will be skewed higher. Measures that correct for that, things like the employment cost index, which the Fed watches, the Atlanta Fed wage tracker, those control for composition, and those have slowed much more.
As we were just discussing with Mike, there has been a real focus change for the Fed to inflation. This is something that you've noted too, that they're more concentrated on inflation. Is it a mistake, given what you're saying and the weakness that may be coming?
Yeah, I do think Fed officials are maybe underestimating a bit the weakness that is still in the labor market. I mean, the hiring rate, which we got in the JOLTS data a couple days ago, that's at levels that we saw in mid-2008. Obviously, quit rates have fallen. Yes, you don't see layoffs yet, but if weak hiring is businesses trying to cut labor costs, maybe to offset high borrowing costs, which they are still very high, 10-year yields are higher than when the Fed started cutting, I don't see that picture changing. changing, and you're just risking getting to that layoff stage at some point.
But again, this builds back into the narrative that the Fed, we're behind the curve raising rates, we're behind the curve, on a number of different fronts. There's summary of economic projections says 4.3%, and I think that's for quite an enduring period of time.
That's
I mean, I do not have a PhD, just for anybody that hasn't worked that out yet. But that's quite a contained and constrained. That's Goldilocks.
Yeah, absolutely. And
Goldilocks doesn't exist.
Yeah. Maybe this time is different. It would be great if this is the soft landing. And there certainly is that chance. We don't see layoffs picking up yet. Maybe we do prevent that. But yeah, it doesn't make a lot of sense to me that Fed officials think that rates are restrictive and still restrictive enough to weigh on inflation, but yet not cause any more of an increase in the unemployment rate.
Can we talk about the politics if they do pause in their next meeting? That you'll have had a Fed that cut 100 basis points before Trump was inaugurated. Trump gets inaugurated and then they decide to pause. I know they're not political, but there is political pressure there, Veronica.
Yeah. I'm sure there will be headlines and comments and tweets and things like that. But yeah, I do believe that the Fed is apolitical. If they pause, of course, in January, it's not going to be a surprise to anyone, of course, right? We've known this now for a couple months.
In terms of the actual policy, we've spent the past hour talking about 100 executive orders on day one big beautiful bill. Now the risk is this: in that one big beautiful bill, it is about extension of the tax cuts and some. So that is perhaps the floor aspect to a lot of the economic analysis. How are you thinking about that at the moment?
Yeah, there is still, of course, a lot of uncertainty in terms of what we're going to get in spending and taxes and tariff changes, of course. We are expecting that those individual tax cuts that expire into 2025, those get extended. But the way that impacts the growth picture is it really doesn't have much of an impact. That's a status quo policy. It's just that you're not going to get a negative impulse from those tax cuts expiring. Maybe we do get some additional corporate tax cuts. That could be a modest positive. But of course, tariffs are a tax also. And so that is modestly growth negative maybe. And the way it impacts the growth and inflation picture, I think, is still pretty ambiguous at this point.
I was going to say, if you look at our reporting of what's in the first 100 days, it is so squarely focused on immigration. You have closing border crossings, building the border wall, carrying out mass deportations. Have you modeled in what some of this might do to the labor market?
Yeah, we're not expecting, honestly, big deportations, just precisely because it could have a pretty big impact on the labor market if we are talking 10 million people. Certainly we could see some of that, and the flow of new immigrants could be slowing. It already has started to slow. Maybe that has been some reason for strong economic data the last couple of years, in which case that would ease too. But we're really not expecting the big disruptive policies, and in which case it could mean a weaker labor market.
What's your tail risk here? We're just seeing a headline break across the Bloomberg terminal that oil's at a 3-month high. The consumer is strong. We know that. They've got low mortgage. They've got access to credit. Access to credit is fine in this economy. Your take on the consumer 2025, because it is bifurcated. We know that. That was 2024's story. What's 2025?
I think that's still a big part of the story for 2025. Certainly, yes, if you are a higher income, hold assets, own a home, you're doing pretty well. But the lower end of the income spectrum is probably not. We do see credit card auto delinquencies, which are still above pre-pandemic levels, savings rate, which is lower than 2019 and falling. If job growth is slowing, which even in payrolls we do see it slowing, that's where we calculate income from. That just means savings is going to fall even more if people don't pull back on spending.
Okay, so still in the lower numbers, cuts not hikes. That would be the base case for Citi. Veronica, thank you very much.
Thank you.
Let's see what the number is. We're beating that drum to 8:30 a.m. Eastern European time. Veronica Clark there of Citi. Coming up in the show, Danny and I will take you through what the president is looking at for sweeping push for his policy agenda from day one. The first 100 days of President-elect Donald Trump.
This is Bloomberg Brief. Danny Berger and Manus Cranny in New York. Manus, did you want to give a correct for a
small
time
correction?
zone?
There is no such. Well, we don't think there's Eastern European time. Of course, it's Eastern time. 8:30 Eastern time for your jobs report. That's
There
a
you
correction.
go.
We should have a little red banner at the bottom there. I don't know what time zone I'm in anymore.
Manus, you've worked in too many places. This is the problem.
Too
We're
many
in New
places.
York City. It is Eastern time. Thank you.
We are the global team. Let's get to politics. President-elect Donald Trump is planning to hit the ground running after his inauguration. Sources say Trump intends to kick off his second term with a flurry of executive orders tackling immigration, energy, regulatory reform immediately as he gets started. Let's bring in Meghan Crane. She's in Washington. Meghan, this is an expectation of a heavy set of executive orders. 100 is expected on the first day. This is about the theatre of making good on the political promises on the campaign trail to his mega base, isn't it?
Yes, good morning. Absolutely. This is very much about filling campaign promises and making sure that he sort of begins his term with momentum. We talked about earlier this week how it will be quite difficult to get, that big spending bill, that big tax cut bill through Congress. So this is sort of a way for Trump to get things rolling without any assistance from the other branches of government.
Meghan, we also heard from Trump yesterday at Mar-a-Lago telling reporters that a meeting with Russian President Vladimir Putin is being arranged. Trump had really given no comment as to whether he had talked to Putin recently on the campaign trail when he was interviewed by Bloomberg. What does it mean about Trump's priorities and what a meeting like this could actually look like if it indeed is being arranged?
Right. So Trump has made maintaining a relationship with Putin, a priority. He certainly did that while he was in office previously. And, the Russians this morning said that there were no specifics yet, but they certainly didn't deny that a meeting was in the works. Also, the president-elect has made very clear that he is focused on trying to bring an end to the war in Ukraine. So whether he'll be working with Putin to do that is sort of unclear, but he certainly is focused on that part of foreign policy. Today's
a pretty important day for President-elect, isn't it, Meghan? You've got the Supreme Court clearing the way for Trump's sentencing. Now, this is in the hush money case. It's set to go ahead. The scale is this. I mean, if you look at what in the story, the burden of sentencing on Trump could be relatively insubstantial in light of the New York judge's plan not to order prison time. But this is, of course, about what the media will make of this in terms of a sort of a blow to President-elect's standing as he goes into office.
Right. So Trump definitely did not want this to happen today. He did a lot, did what he could legally to try to prevent it. Even if it doesn't mean jail time or significant fines, which is sort of what we expect, it's still unprecedented, right? The incoming president of the United States will be a convicted felon, and that will stand as a fact, as he takes office, which is just never happened before and certainly not a good look for him, I suppose, is one way to think about it. It does, open the lane for him to appeal that verdict and that conviction. So, it sort of sets up a different path. But, while he takes office, when he puts his hand on the Bible, he'll be a convicted felon.
Meghan, one of the other machinations that's been really front and present in this incoming Trump administration is moves from the tech world. This I thought was really interesting. NVIDIA slamming the Biden administration's decision to put more restrictions, to put this three-tiered system into who can get NVIDIA chips. The VP of Government Affairs saying we would encourage President Biden not to preempt incoming President Trump by enacting a policy that would harm the U.S. Is there some degree where some of these tech companies see Trump as a way to bail them out and to fix some of their woes that they've been dealing with, whether it be with the Biden administration or abroad?
It certainly seems that way. They have been, many of them, flying down to Mar-a-Lago to meet with Trump, and certainly expect him to be more friendly to their regulatory requirements and the regulatory issues. It's been an interesting transition in that Trump has been quite active very early. So it seems like the tech companies are embracing that 100%.
Well, we'll see if Jensen Huang makes the pilgrimage down to Mar-a-Lago. Meghan, thank you so much. Meghan Crane there in Washington, D.C. for us. Earnings are now starting to trickle in. We're going to get Delta reporting before the market open. Bloomberg's Sid Phillip joins us now for more. Sid, set the stage for us. What are we expecting from Delta today?
Morning, Danny. So for Delta earnings, everyone's been looking at to see what the expectations are going into 2025. In the run-up to 2024, earnings have been great because there's been a sort of lot of demand. There's been a lot of pent-up demand that continues to sort of people continue to travel. And so everyone's looking to see what 2025 ushers, especially the first half and the first quarter, because that tends to be the weakest quarter for airlines. And so everyone's looking to see what the outlook really is for the first quarter.
Well, they put quite a feast on display over at CES, didn't they, in the Sphere? When you look at the airlines last year, 57% up in the S&P 500, Delta up 47%, United up 141%. This is about getting the front of your cabin right. This is about having global and international proposition rather than just being that domestic player in the United States of America. What do we know about what they're able to squeeze here? Because this is all about, you know, that revenue per available seat, and that's about the front of the bus or the plane.
Absolutely. Revenue per available seat mile is basically the metric everyone's been looking at in terms of what Delta Airlines goes from here. I mean, they've been talking about how they're looking at premiumization of the cabin. They're looking at how they're offering more and more premium seats. And they talk about how there's more and more leisure travelers willing to pay more to travel. And so while the ultra low-cost carriers in the US have been hurting, the full-service carriers like Delta, United, and everyone else have been sort of seeing a resurgence in demand. And they've seen tons of people sort of tracking them. And as more and more people travel, and given the fact that they have such a wide network both domestically and internationally, it helps them sort of de-risk their business as they go into sort of 2025. And the fact that they're able to sort of leverage that network allows them to sort of get that revenue, especially with costs rising. It is an important sort of metric to get that margin going up.
Well, of course, they have got the capacity constraint themselves along with everybody else. That is a natural boost to prices. They have us, Sid. They have us every which way we turn. Sid Phillip there. We're setting you up for Delta. Danny and I will set you up for your jobs report in just a moment. That is officially at 8:30 Eastern time.
Not Europe?
Not Eastern Europe. No, not Europe. Not Europe. I know my time zones now. I live in New York.
It's the last day of the trading week. Let's get you set up for it. The main event will be at 8:30 a.m. Eastern Time. That is the December jobs report. That will be followed by University of Michigan consumer sentiment numbers. Those come at 10 a.m. And then President-elect Trump's sentencing for his hush money criminal case. That is scheduled also for today in New York. Manus.
Yeah, that's going to be interesting. Danny, a couple of stocks to keep our eye on. Travelers. All states are among the public insurers most exposed to the LA fire risk. That's according to JP Morgan. The stock is down by 5%. Costco, Danny and I are going to go to the one in Brooklyn, apparently. We've just agreed a day trip to Costco in the city. Gains as December comparable sales top out estimates. Danny and I did not help that number. Advanced Micro Devices, or I didn't. Advanced Micro Devices down 1.76%. AMD cut to neutral by Goldman Sachs. Price target 129. S&P had also removed AMD's outlook from positive to stable. That was yesterday. Danny.
I just want to establish, because I wasn't sure, there is indeed a Costco in Brooklyn, but Manus and I also need to pay the congestion charge for coming back in, so maybe it's not worth going to Costco. I don't know.
$9?
$9.
But apparently you get good hot dogs if you go to Costco, I'm told by the producer.
It's true. It's an American experience you are going to need. Manus, speaking of American experience,
yes.
Let's leave you with this. The estimate for the jobs number coming out later, a wide range, 100,000 to 168. I'll leave you with the whisper number, Manus.
Well, the whisper number is at 182,000. Veronica Clark from Citi is at 120,000. You want to focus on that unemployment rate, which Citi say is going to hit 4.5% by the end of the year. That's going to give you a Fed that's going to be cutting rather than hiking. So says Veronica Clark at Citi.
And what huge rally, what might we see in the bond market if that happens, considering the sell-off we've had? All right, that's it for us. Surveillance is ahead.